I think we now have audio. So, all right, very good. So what I was saying before I realized, and thank you, William, for letting me know that I was on mute. Matter of fact, my interface was just all jacked up. I couldn't even hear music. Nothing was going on. So, but what I was saying is I hope everybody had a great weekend. It was a busy weekend here at my family. We wrapped up a 14-year running career for my son. He had his final track meet Friday night, and it was 14 years of running. And now he's going off to college. He will not be running in college. He's going to be focused on academics. But I coached him, myself and a good friend, for 9 years of those 14, the last 9 years of his career. So it's kind of wild, that many years of coaching and training and running with my son and all that kind of stuff to just have an end to it. But you know what? It was an amazing time nonetheless. And it was great to have that opportunity to be with him. So, and then, of course, I still got my daughter. She's growing up. She's still got 2 years of running. And then I've got a younger one that is now in soccer and running and things like that. So I'm not done. And I'm excited about that. It's great. So, and then we, of course, had Mother's Day. Hope everybody had a great Mother's Day. And sometimes I know that can be a bittersweet time. It's great when you have a mother and that kind of stuff. And it's difficult when you maybe have lost your mom or anything like that. So it's a bittersweet time, but it's still a time to honor those that the mothers that we've had in our lives. So nonetheless, hope everybody had a great weekend and is ready to start a great week. So today, we're going to be covering a few articles, like always. So before I even get into the actual show, I want to just briefly talk about the interest rate. We do that at the very beginning. It's Monday. I typically do this on the first show of the week, and then I'll do it again on the last show of the week. And for those that don't know, I live stream Monday through Thursday, 8:30 a.m. Eastern, where you're watching me now. So that's what I do here. So mortgage rates. Let me show you this. There we go. So currently, the mortgage rate is 6.42 for 30-year fixed. That's down 0.02. Guys, I mean, this is 2 weeks now. We fluctuated very little. There's not been anything crazy here. It's really just kind of been a slight adjustment here and there. Nothing drastic whatsoever. Let's see. There was an article I was going to briefly. Calm and slightly stronger, but yeah. This is the article. Calm and slightly stronger, but volatility will be back. Once or twice per week, the bond market manages to post a fairly calm trading day against the prevailing backdrop of generally higher volatility. Today was such a day. The most helpful catalyst was an absence of any major war-related headlines and associated oil price volatility. That said, it's a near certainty that war-related volatility will be back in the coming week. So what we have seen, though, is like, even though all the war and all this headlines, that kind of stuff has been happening, we've not seen any drastic change one way or the other in the interest rate. It's been marginal. And to be honest, it's overall a really good thing. It brings more of a confidence into the market, and especially this time of year in the spring. That's very, very important. We need to settle in and just kind of rest there. And we don't need to forget, though, too, and I know you agents out there know this, but the historical norm, like if you look back over the past 20, 30, 40 years, it's hovered right around the 6.5% range and almost 7%. So the reality is this rate is more of a balanced, normal, typical market. And we need to keep that in mind. And I got an article, we're going to be talking kind of about that. So we'll talk about that a little bit later. And but let's just keep that in mind. It's not a drastic one way or the other. In today's show, what I'm going to be covering today is, I wanted to actually go live on Friday to mention this, but I just didn't have time. We've been kind of on this whole journey of what is happening in our industry. And when it comes to consolidation, private listings and coming soons and MLS and Zillow and Redfin, all these type of moving parts. And there's been a lot of acquisitions and consolidation and things like that going on. And we've talked about, where Compass bought out Anywhere. We then talked about Remax, Real Brokerage and Remax combining. We talked about the Compass and Redfin deal, MLSs. We talked about going national with MLSs, all these type of things. So this is just what is very heavy in our industry right now about being, talked about. So this will be today's show. I can't really get away from it because it's in every single headline. and it's moving just rapidly. There's all kinds of stuff constantly happening in our industry right now in regards to these topics that we're just going to kind of keep reading through these and staying on point, because I think information like this is just going to help us navigate, the future of our industry and what it's like to be a real estate agent and what that looks like in the future. So paying attention is very important. So in today's show, I've got a few articles. The first one we're going to begin with, and this is where I was wanting to talk about this on Friday or Saturday, just didn't have time, was EXP, the national franchise EXP acquired NextHome as executive site tipping point of industry evolution. So that's the article I'm going to be reading. But EXP has now acquired NextHome. And there's been so many of these type of shifts and stuff going on. It's crazy. It's just crazy how much consolidation is happening on these national franchise fronts. Bobby, good to see you, my friend. Hope all is well. Thanks for being here. So we're going to talk about the EXP and NextHome and that acquisition. Then we are going to dive right back into a topic in regards to Zillow and the platforms and portals. There was another article that came out yesterday. Yeah. Oh, good, Bobby. Thank you. Yeah, very good. Yeah, earlier, Bobby, there was something that was off. I had to restart my audio interface, so I think it's good now. But thank you so much. Yeah, so we're going to talk about an article about the real estate platform, not what people think. And last week, and I'm just setting the stage now, or even kind of going back to what I was talking about last week, just briefly before we get into the show, is last week I was pretty harsh against Zillow and attacking their premise and kind of their press release and what they talked about, like how they're consumer focused. And there's reason for that. It's not like I'm against Zillow and everything. I had a lot of comments, like I understand that our industry is a little bit divided in regards to like the benefit of Zillow and then the issues with it. But the reality is in that show, what I was talking about is the issues with it. And there are a lot. There are situations where Zillow tries to come off as they are trying to set the standard for what we do. They're trying to, make sure that they're the ones that are the orator of all this and all this kind of information. And I was honing in very strongly into that realm. And that's what I was talking about. And we're going to go back into that a little bit, because we need to be aware of what Zillow's role is in our industry and not just what they want us to believe. And it doesn't mean I want them to, not be around or close up business. That's not the point. The point is bringing clarity to the reality about what it is they are and what they are not. And we need to understand that to be able to navigate our industry, which we are real estate agents. That's our jobs, and what their role is in response to our jobs. And that's the clarity we're looking for. So I'll be talking about this article again, another article talking about this very subject. And then we're going to briefly go into a conversation where the the FICO score and stuff like that are now beginning to look at looking at your credit score based on rental history. And there's kind of a little bit of an update here in regards to what they're calling it VantageScore 4.0. And if you don't know what VantageScore is the one that keeps track of all the different credit unions, Experian and them to give a credit score. So VantageScore is now developing another algorithm-based metric and point that as your credit score based on your history rent, your rental history, and your utility history and payment history and that kind of stuff to help your score go up higher. So this is kind of a shift that will lead to more people being qualified that might have had a lower interest rate. So it's going to be fascinating to kind of see where this goes. And then we're going to end, if I have time, on an article that just kind of helps you guys think through some things about the market and some myths that we hold on to. And it says, what won't happen? The 3 market myths holding your clients back. So that's the articles for today. So let's go ahead and jump into this. Yep. Good morning, guys. Thank you guys for being here. Very good. All right. Welcome to the Real Estate Brief. I'm Adam, and today we're cutting through the noise. We're going to get to the truth in the news, look at the data, and I'm going to give you some of my observations and where I believe you can find opportunity. So if you're ready to gain your real estate edge, let's dive into our very first story of the day. So today we're going to be talking about the very big news that another acquisition has taken place inside of our real estate industry in regards to national franchises. And what this article is going to be talking about is EXP has officially acquired NextHome. Now, this is marking another massive shift in how brokerage models are consolidating across pretty much across the board. All of your major players now have begun to merge or consolidate or be bought out or whatever it might be. This is happening across the board. We talked about Remax and Real. We've talked about Compass and Anywhere. And now this next one is EXP and NextHome. I just want to throw this out there. Keller Williams, what are you going to do? I'm waiting for you guys. I have a feeling there's something going on, and that's going to be the next announcement, is that KW does something as well. They're the ones that's another big national franchise that has so far not done any kind of this, and maybe they're not going to. I don't know. I'm just saying, like, it seems like everybody is, and that's the last big national player that hasn't done something. So we'll see what happens. That's my prediction. I have a feeling, could be this week or next or something like that, that Keller Williams does something. I don't know. I could be wrong. All right. So let's go ahead and get into this article here, because it is news. It's just more news for our industry about what's going on and keeping our fingers on the pulse so we can have the real estate edge. So let's go into this. EXP acquires NextHome as executives cite tipping point of industry evolution. It says the acquisition marks another major real estate consolidation this year as companies with different business models band together in a fast-shifting brokerage landscape. And this is what's happening, is all these executives that are part of these big national franchises, they're having all kinds of conversations between each other. And what they're really doing is they're looking at their reach as far as their market share is concerned, their agent base, the needs of the agent base, and matching that up with scale of technology. And they're trying to work out deals that bring those two things together. And it's a good business response to what Compass has done with Anywhere, because, and really, let's be honest, this is a response to that deal, because Compass acquiring Anywhere acquired Century 21, Coldwell Banker, ERA, Better Homes and Gardens, Cochran Groups. With that purchase, they got all of these massive national brands under one umbrella. So it's a massive move of over 300,000 agents across the country now moving under one brand, or, well, one main company with one main agenda, okay? So it's a big mass, a big shift. So now what we're seeing is these other big players now having conversations with other ones that are complementary to their businesses models, and then helping them to broaden their scope. So this is where capitalism and the American fair trade and all this kind of stuff wins, right? Because as agents, what we're going to end up having is, instead of having all of these big national franchises, we're going to have more of a consolidation, kind of similar to what you saw in the airline industry, right? You used to have all these little, smaller airlines that were gradually bought up by the big players, Delta, American Airlines, and so forth. So United and all them. So very similar to what we're seeing now. So this is beginning to happen. So this is just a continuation of that. With EXP acquiring NextHome, it's another step in that evolution, leading us to more of that centralized location of just a few big national brands. And these are all in response to Compass and Anywhere acquisition. So this is just following suit. So let's go ahead and get into this article. It says, virtual focus brokerage EXP announced it is buying NextHome in a move that pairs yet another high growth tech focused company, okay, that's the key, with a more traditional franchisor as the industry rapidly accelerates through an unprecedented period of consolidation. So if I give you a little bit of context here, and most of you guys know this, but EXP would be considered more of like just a cloud model. In certain areas, they might have like a little office area typically paid for by an agent or broker in that area, but overall a cloud model. NextHome would be considered more of like a boutique type franchise. It was focused on more of a rural, smaller type boutique type structure, but still was a franchise and has its fingers in a lot of different areas. So this combo, this consolidation here takes EXP from just being a cloud model to being into more of like a boutique type feel, while at the same time, NextHome takes them into being able to offer a bigger, stronger tech deck to the agents that they had. So this is what we're looking for. And so when you start talking about consolidations across major franchises, this is what to look for. So if you start thinking about ones that have not actually taken the leap and merged or acquired other brokerages, take it for example, right now, I talked about it earlier, is Keller Williams, as of right now, has not mentioned any kind of consolidation or acquisition or anything in regards to their brand is concerned to take advantage of all this shifting. Now, I foresee something happening in the near future because all the big players are doing it. So I have a feeling it's going to come, but the combination is typically tech related versus agent reach. or boutique reach, right? It's like that's the things that are converging. And that's what we're watching here. That's what's happening here. It says, in an announcement today, eXp and NextHome executives characterized the deal as putting both companies on a united platform, even as NextHome will continue to operate independently, saying the combined company aims to offer maximum optionality to agents. It says the industry has reached a tipping point, and this is so true. A one-size-fits-all model no longer works for the visionary entrepreneur, said Leo Parisia, CEO of eXp Realty, in a statement. It says, we're building a platform that supports multiple models because every agent and every consumer served deserves choice. And let's just pause for just 1 second. Is what's happened in this industry for the most part is that things are converging where your brokerage models are becoming a one-stop shop for agents to put their license in that offers every type of tool and system that they need to be able to function and do their jobs. So it's basically like taking like a business consulting firm with all kinds of tools and resources and another business being able to plug directly into that model to be able to function at a higher and faster pace to maintain competitive advantage. Okay, so these major players are looking for acquisitions and consolidation that gives them that platform to help service those agents better. So that's why when you start looking at this from the bird's eye view, you start seeing the play is this is not just about real estate sales. It's not just about real estate agents. It is all about multiple levels of service. We're talking about title and transaction coordination. We're talking about portals. We're talking about technology, website reach, marketing, all those things coming under one umbrella. We're talking about mortgage, relationships inside of brokerages. So everything's kind of coming in. You're going to probably start seeing insurance, all those type of things happening where agents can take their business and plug it directly into a model that is working. So these are how these executives are thinking. They're thinking, how can we build a very strong, robust model that appeals to a broader audience of agents? So then the agents can then shop around these big brokerages and figure out what works best for their business model. And that's kind of where we're heading. All right. Though the companies did not share details about the financials of the transaction or how NextHome will integrate with eXp, an eXp spokesperson told Risk Media that in the near term, agents at NextHome will benefit from eXp systems and technology, even as NextHome leadership will continue to lead the company with autonomy. So there's like a partnership of some kind here. We're not given many details, but it's a partnership. Two big companies coming together and working out a deal to work together. NextHome was a nimble and highly strategic acquisition for eXp. While the purchase price is not being disclosed, we used existing cash on hand to transform eXp into a multi-platform model, reflecting our focus on deploying capital with discipline. The deal comes only days after Real Brokerage bought RE/MAX for $880 million. If you've not heard about that, you can go back and watch my live stream. That's right, Real Brokerage now has brought out RE/MAX over the last year or two, seemingly driven at least in part by policy shifts in the wake of the commission lawsuits, as well as consistently low home sales. So it says, we looked at every real estate company across the U.S., said NextHome founder and co-CEO James Dwiggins in a statement. What does that tell you right there? What does that say? That means these executives at all these companies are having all kinds of conversations. There is probably conversations happening on the phone everywhere across this country with these executives talking about their brands, how they align, what can they offer each other. There is a lot of conversations happening that we're just not privy to. And eXp aligns with us the most, from company culture to philosophy to a leadership team that truly advocates for agents and consumers. This is the right partner to grow the NextHome brand and lead franchise expansion across the world. So we're going to see more of this, guys. All right. Synergy. Dwiggins has become one of the more outspoken brokerage leaders on industry topics. With a popular podcast and a significant social media following, he has been sharply critical of Compass and other companies that have pushed forward on private listings and more opaque pre-marketing strategies. So he's been very vocal about this. He has explicitly lauded Parisia, who has also lambasted private listing practices in the industry for his approach to those issues. While Leo and I are competitors, it's no secret that we share the same vision on hot button issues like private listings and making sure home buyers and sellers are being protected. I have to give him massive props in leading the charge, Dwiggins wrote on LinkedIn earlier this year. Look, this is where the camps are probably going to be split, and in some ways you're going to have different business philosophies that is shaping up. So eXp and NextHome are taking the position that they don't like the idea of private listings. That's going to be their model. And for some agents that agree with that, it's going to be more at home at that type of brokerage. That's the line in the sand that they're choosing to make. The other agent that says, hey, look, I like the idea of this coming soon, pre-market, testing the market, I don't see this as anti-competitive or whatever, are probably going to align more with the Compass camp and those that agree with that model. So you can kind of see how there is a fractioning happening. But again, it's still, there's arguments to be had on both sides. But this is what's happening. There's a little bit of a divide and rift happening here. It says EXP announced a non-exclusive pre-market partnership with multiple portals back in March, claiming that a coming soon approach is something sellers want, but vowing the company was still committed to following MLS rules and giving sellers the widest possible audience. Now, the funny thing is, and I don't think anyone disagrees with that. Like, I mean, if the statement is trying to position themselves in a place where they're not like Compass. Compass doesn't say that either. Compass would agree with this. Like, that's not a dividing line. Maybe some slight interpretation might be there, but it says, on the other hand, Compass has used partnerships and acquisitions to push for change to MLS restrictions on private listings and expand its own exclusive inventory. Compass CEO Robert Refkin told investors earlier this week that he hopes to create a national MLS in order to facilitate seller choice and pre-marketing, as the company has incentivized agents to utilize its strategies. But see, that's the argument is not, and I don't mean to harp on this too much, but the argument is not that we're trying to limit the amount that the consumer sees the property. That's not the position of Compass at all. That's not the position of anybody that would agree with what Compass is saying. The whole point of Compass is like, well, the agent's doing all the work, and the MLS and what we do should get priority, not the portals. So that's why he's going out and talking to these national MLSs. Like, he's not saying like, I want to restrict and not give, sellers the widest possible audience. That's not the position. I think everybody would agree that the broader it's marketed, the better. The really thing what we're trying to do here is just put the control back in the real estate agent's hands and not let the portals decide. All right, but EXP characterized the NextHome acquisition as about a different kind of choice, a choice for agents, saying that NextHome's franchise model offers every entrepreneurial real estate professional a seat at the table on their own terms. How exactly integration happens will be closely watched. It says, just this morning, Real CEO Tamir Peleg told investors that the day the RE/MAX deal closes should be a boring day in the best possible way for brokers and agents. And COO Jenna Rosenblatt promised no forced migration for RE/MAX franchises. Adding the NextHome franchise model gives our agents and franchise owners maximum optionality. So there's the facts. There's the information about that. I don't know much about NextHome. Let's just quickly do this. And I don't know if we can find out any information in regards. If somebody's out there and you guys know something about NextHome, let me know. I don't know like what their models are, like how they operate. I know EXP is very similar to Keller Williams. I mean, they're very similar. So one's a cloud model. EXP was split from KW, so that's a similarity there. I doubt we're going to get like model, like how they charge, what it is. I don't know if we'll get their splits or anything. I'm just kind of curious on like how it aligns, like how different it is about compared to everybody else. It says, number one, franchise by franchise business review, 560 plus office locations. So they got 560 plus offices and 5,500 plus real estate professionals. Not a very large company, guys. Good morning, Kevin. Glad you're here, my friend. Thanks for tuning in. Yeah, I don't know. That's just the news. I mean, there's nothing really groundbreaking, to be honest, in that deal, as much as I was more fascinated with the real brokerage and RE/MAX than I am the EXP and NextHome. I don't see, NextHome's not that big. So, and EXP obviously needed some form of office space, but the 5,500 agent base is not the market share for EXP. I think it's more of just an acquisition. I think NextHome just wanted to be acquired and they got acquired. I mean, I don't think that's really so much anything else. But anyway. All right. With that being said, let's jump into our second article for the day. This one is by Greg Hague. Now, the name Greg Hague should sound familiar for those that were here last week. Greg Hague has basically taken a position with Compass, but pro bono. He's not making any money. He's just in agreement with the way that Compass is approaching the portals and the way they're trying to handle that. And this article here that I'm going to go over is kind of peeling back the curtain a little bit on these search platforms. And it's going to highlight some of the gaps between search tools and then us as a service providers. And it's going to be a little bit of an interesting conversation. And before I get into this article, I'm actually going to be doing something here shortly. I've not had time to build the storyline out just yet, but it's going to be a fun one because my wife and I were out for a run, and I was just it was right after I had this live stream, and I was talking about what Zillow was doing in response to the market and kind of how they've all of a sudden rolled back and said they're going to have these private listings. And then they had this press release that they're going to be partnered with Realtor.com and how they're setting the standard for marketing, all this kind of stuff. And my wife, in her wisdom, says this. She goes, "You know what this story is like?" She goes, "It's like the Bug's Life. It's like the Bug's Life." And I'm literally going to do a video talking about how Zillow is the grasshoppers in that story. Okay? If you've seen A Bug's Life, the moment I said that, you're already making some connections here. All right? So the reason why I'm saying this before I even get into this article is because that's the thought we got to go with. Because if you think about The Bug's Life and you put yourself as agents as the ants and you put Zillow as the grasshopper, it's very interesting thought exercise, isn't it? So I'm not going to get into that today. I'm going to do a whole video on that later, but just ponder that concept. Go and watch A Bug's Life. Okay. I watched A Bug's Life over the weekend just because she mentioned that. I was like, I'm going to go watch that movie again. And the parallels are uncanny. They're uncanny. All right. So let's jump into this article here. This one, I've never featured an article from this website. It's called Ahwatukee Foothills News. I don't know if I'm saying that right or not, but Ahwatukee Foothills News by Greg Hogue. This is the guy, he started 72 sold. That's the guy right there. Let's get into this. Here's something you never guessed just by using it. The country's biggest home search website, the one with the cheerful blue logo. Most buyers tap 100 times before making an offer. Isn't really in the business of helping sellers sell homes or buyers buy them. Not primarily. Not the way most people assume. Now, that's a very direct paragraph. Okay? So what's he saying? It's not about helping sellers sell homes or buyers buy them. Not primarily. That is not their main job. Its actual business is something else entirely. And once you see it, you can't unsee it. So let's go and see what he's saying. Let's keep in mind, this is an opinion piece, okay? Greg Hogue obviously has some bias in his conversations, but let's test and see what he's saying here and see if it makes sense. I've actually not read the article. I kind of skimmed through it a little bit today, but I was like, yeah, okay, this is kind of what I'm seeing. This is kind of the way I feel, so I'm going to see if this aligns. So we're going to do this together. I spent 50 years selling homes, was ranked the #1 listing agent in Arizona, number 19 in the nation by Realtor Magazine, and I'm a licensed attorney in 2 states. I've also served as National Home Sales Strategy Director for real estate brands totaling more than 300,000 agents. I say this with only because what I'm about to tell you is a kind of thing that sounds like a conspiracy theory until you understand the mechanics. Then it sounds like math. And see, math is accurate, okay? Here are the mathematics. So let's walk through this. When a home gets listed, the multiple listing service automatically pushes that listing to Zillow. Okay? That's what happens, right? I go out and I list a home, I put it on the MLS, and what happens? Goes out to all the portals. It says most MLSs now fine agents $500 a day or more if they publicly market a home without submitting it to the MLS within 1 business day of starting any form of public marketing. Now, that's true, and there's elements of where that's true. It is beginning to change a little bit, so we're going to give a little bit of grace there that this is true in some markets. That is still the case. Now, they're rolling that back a little bit. The agent has no real choice. She can't quietly test the market. She can't test the price before it goes live online to millions of strangers. And if she doesn't get the listing on Zillow within 24 hours, and this is still the case, Zillow itself now bans the listing forever. Read that again. The website that didn't even create the listing has imposed a rule that punishes the agent who did. This goes back to what I was saying last week. It's like Zillow's setting the standard. They said we're setting the new standard. Okay? They didn't do any of this. They didn't get this listing at all. Okay? The website that didn't even create the listing has imposed a rule that punishes the agent who did. Why? Right? Why? Why are we getting punished? Because Zillow doesn't make money when a home sells. Think about it. They don't make a dime if we close that property. Nothing. Zillow makes money when a buyer who landed on a listing gets routed to an agent who paid Zillow for the lead. That paid agent has often never seen the home, has never spoken to the seller, knows nothing about the neighborhood, the schools, the foundation, the recent kitchen remodel, the reason the sellers priced it where they did. Worse, that agent has a direct financial incentive to steer the buyer away from the home she clicked on and toward a listing he or she personally represents and stands to earn a commission on. Now, I know that does happen. But again, as much as I would probably agree with a lot of the points he's probably going to make, I will push back just in our industry and my experience a little bit and say that that's not always the case. And I wouldn't say that. I wouldn't say that agents are steering. I know it happens, but most agents want to make a sale and they're okay with taking buyers through any home that's on the market that they want to see in hopes of helping them find the home they want to get it under contract. That is the majority of what agents do. That part I would just push back on him a little bit. The buyer is deserved. Disserved. The seller is disserved. Both are walking through what looks like a helpful tool and is really a routing system built for someone else's revenue. Isn't that what it is, right? It's a routing tool. The listing is the bait. The lead sale is the business. Now look at the design choices through that lens and watch them light up like an X-ray. Listing agents can't appear in the photos, can't include their phone number on the page, can't link to their own website where the home might be presented far more compellingly, can't even mention a custom URL built specifically for the property. Okay, we can't do any of those things, right? It's all neutral. I can't be creative in my marketing with my property where it syndicates to. I can't do anything with it. Why? Because everybody says I have to keep it neutral. I got to dumb it down. All my marketing stuff has got to look like everybody else. Buyers are nudged gently and constantly toward a big, bold contact agent button that looks for all the world like it connects you to the agent who actually listed the home. Now, doesn't it do that? Isn't that kind of odd, right? It doesn't, though. It sends you to whichever pay-for-lead agent is buying that zip code for that month. It gets stranger. Zillow now displays offer strategy guides next to some listings, suggesting that buyers offer less than the asking price. Are they servicing the seller? So here's the thing. This is the argument. I owe fiduciary responsibility to my seller. I'm now forced to market my property everywhere. And if I don't, I get penalized or banned. Okay? And then I have to dumb my listing down to be neutral, just like everybody else's, to then market for my seller alongside a guide that tells buyers how to take that home and offer a lower asking price. How does that serve my seller? You agents out there have listings. Let me ask you that question. How does that help your seller that you owe the fiduciary to? The seller paying for the privilege of being on the platform through commissions baked into the transaction is having the platform itself coach buyers to negotiate them down. None of this was created to protect consumers, but that's what they keep saying. We're here for the consumers. It was created to protect a business model. Most agents won't tell you any of this, partly because they don't know how to push back, and partly because the rules have left them with no real alternative. That's true, right? Bug's life. The platform has become the air. You can't opt out of air. But you can ask questions. You can ask your listing agent, Which platforms divert buyers away from the person who actually knows your home? You can ask whether your listing is being promoted somewhere besides the place that profits from selling leads against it. A few of us inside the industry have been objecting for years. It hasn't been enough. But when consumers start asking and start objecting, everything changes. That's when platforms will rewrite the rules. That's when professionals will find the courage to demand it. See, we're the ants. Us agents are the ants. We're going out, gathering the food, preparing the food, which is the house, getting ready for market, putting it out there, and then the grasshoppers come and take the majority of it and then give us a little bit of it back. But if I want to pay more, I'll get more of it back. Right? Like, as much as I don't want to be solely just attacking Zillow, he's not wrong when he says once you see it, you can't unsee it. And I'm at the place now where as I read more and more about this, I'm having a hard time seeing another argument against this. It's putting the agent at the mercy of a marketing platform that the seller now is being offered up on the plate of the stone of offering, if you will, to Zillow to then profit from, while they encourage the buyer on how to negotiate down the list price of the seller that is choosing to put that home on the market with. Odd, right? So weird. It's so weird that we're here. Consumers do not realize this, right? They get on Zillow and they look at Zillow and they see all these things and they think that Zillow is giving them just free data and free information. Guys, as a consumer, you're what they're selling. You're the data. You're a product too. They're creating a product out of you. We're creating a product out of the seller, and in the middle, Zillow's winning. So it's a game. It's a game of business. So I have a hard time unseeing it. I really do. And like I said, I'm going to do a whole deep dive in this because, matter of fact, I am trying to find, going back to where they're talking about EXP and NextHome was talking about how they, don't want to have all these private listings, this kind of stuff and all that. I understand that their premise is that they want to, market their properties out to the broadest audience possible. But are you guys doing enough research in this to say that for the sake of marketing, that you think you're doing the best thing for someone else's profit? Are you doing the right thing to protect your own agents? Are you really doing that? Are you going through this and saying this is the best solution for our agents? Right? Because right now, portals think that they control our market. They think they control the product that us as agents are creating. That's what they think. That's their position. And look, I don't think it is. I don't think it's their call. I don't think they should ban us if we decide not to market. I don't think they should penalize my sellers because a seller says, I don't want to put my property on your website that shows up right beside an article that tells the buyer looking at our property how to negotiate down on me. Because the product you're selling is my home, right? It's really odd, guys. It's really, really odd. All right. You guys get it. I mean, I can't get off the soapbox because it just keeps popping up. All right, let's now shift gears. I'm not going to talk about that anymore today. We're going to move on. This article is by Realtor.com. This says, this change to credit scores could help 7.7 million Americans qualify for a mortgage. Freddie Mae and Fannie Mac are shifting now. They are looking, the way they kind of look at credit. And what they're going to be doing in this article here we're going to go over is rent history. And it's going to be coming through what's called VantageScore 4.0. This is a good opportunity for a lot of first-time home buyers that have been really close to that financial margin of a lower credit score because maybe they just haven't had enough credit or enough time to build credit. Think like a younger buyer. This kind of change we're going to go over right now could add a good shift into that market and help the first-time home buyers enter into the market and help their credit score go up a little bit higher. So let's talk about this because this is kind of a fascinating conversation, and we'll see where this lands. A government change could tip the scale for millions of credit invisible Americans and spur hundreds of billions in new mortgage originations. In a rule change finalized last month, government-run mortgage giants Fannie Mae and Freddie Mac said they would accept mortgages underwritten with a credit score model that takes on-time rental payments into account. That is a big shift, guys, right? So if you have a rental history, it's going to now be a factor in the credit score. VantageScore, the company behind the credit scoring system, estimates that including rental payment history allows about 7.7 million Americans to boost their credit score above 620, which is your benchmark, potentially making them eligible for traditional mortgages. Additionally, the company says this approach improves risk prediction by identifying up to 11% more defaults in the riskiest score ranges, potentially reducing the rate of future defaults. It says the change could make a difference for a small but growing share of borrowers, freelancers, self-employed households, gig workers, or young people and immigrants with good, reliable cash flow, but a thin credit file, says Realtor.com senior economist Jake Krimmel. Quote, they are probably qualified as a whole, but not on paper under the current rigid, outdated system. So this is what is changing, okay? Fannie and Freddie buy whole loans from mortgage lenders to package as securities for investors, and the rules they set for eligible conforming loans have major influence on the market. Yeah, they buy a lot of the loans, guys. Freddie Mae and Fannie Mac are massive mortgage purchasers. U.S. Federal Housing Finance Agency Director William Pult, who also oversees Fannie Mae and Freddie Mac, announced April 22nd that they were expanding a pilot to allow mortgage lenders to use VantageScore ratings to assess borrower credit worthiness in addition to or instead of traditional FICO scores. Okay? It's a big shift. VantageScore is a scoring model developed by three major credit bureaus, right? This is the Equifax, Experian, and TransUnion. They cooperate it through a joint venture called VantageScore Solutions, LLC. Its trended data takes into account rental and utility payment history reported to the bureaus. Montana-based credit scoring mainstay FICO now also considers positive and negative rental payment history reported to the agency in its FICO 10T. Okay, so think about this. If they've never owned a home, maybe they don't even have any revolving debt. Maybe these people just use cash and debit cards and they've never developed any kind of credit at all. And now they become very difficult to buy because there's these outdated models to help their score, because that score is a major impact to see if they can get a loan or not. So this has opened up a massive amount of buyers. And then in the announcement, Pult framed the change as a modernization of consumer credit. Late rent and utility payments can negatively impact credit scores. So the lack of a positive impact from payment history was nonsense. And this was the thing. It's like, yes, those late rent, like a landlord or utility companies could record and send into those credit unions if you were late on this kind of stuff. But none of the current paying your rent added to your score. So you can get penalized for it, but gain nothing for it, right? So that's what they're looking at here. The National Association of Realtors and the Mortgage Bankers Association applauded the move as a modernization of credit reporting, tipping the scale for the credit invisible. Last year, only about 13% of renters benefited from positive rental payment history in their credit reports. California, Colorado, and New York have already enacted programs for rent reporting. 9 other states have considered legislation. VantageScore Solutions believes almost 7.7 million Americans would see a boost to their credit if the model went nationwide. And it also believes that data helps better predict who will default and who won't. Do you see how this could really help, like someone just getting out of college, they got married, they spend a year renting, and they get no credit at all for the rental, for their consistency in payment, right? Now they would, right? The model allows borrowers to demonstrate responsible financial behavior that legacy credit scoring models currently overlook. All right, mortgage lenders embrace the change. Pennsylvania-based mortgage lender NewRez, which originated the first $10 million in loans using this data, found the process could run very similar to its normal lending process, said Bob Johnson, head of originations at the company. That validated the idea that a new credit score model can be applied using the same processes. Paired with strong controls and underwriting discipline, the new model provides a more holistic view of a person's credit. It does, doesn't it? I mean, if you really stop and think about this, it's like, what is credit score to begin with? It's showing a consistency in in the way you pay bills, right? Like it shows my financial responsibility to manage money. And if a segment of the way I use my money is excluded from helping my score, well, then it's kind of not the full picture. It doesn't give the whole idea. And why couldn't mortgage lenders out there use your rental history to validate your credit score? Why couldn't they do that, right? How's that any different than any other kind of system that keeps track of your score, right? Of your payment history. It says for consumers, the takeaway is straightforward. Consistent on-time payment behavior across a wider range of obligations can now show up in a credit score in ways it often did not under the legacy models. That is particularly meaningful for thin file and previously unscorable borrowers. In an April 29th call, Fannie Mae acting CEO Peter Akwaboah said the move would support affordability and access through industry innovation and competition. Assessing potential risks, there's obviously going to be some. The economist Krimmel says that modernizing the credit scoring criteria in this way will help people with steady income, but who may have a thinner credit history. There is some risk, though, he says. FHA delinquencies have increased, though that could partly reflect the fact that these right marginal borrowers are being shut out while the wrong ones slip through. So the data is a little bit skewed there, it sounds like. Still, the change happens at a time when young people are overwhelmingly pessimistic about the housing market. They blame a variety of factors, including a lack of housing supply driving up prices. Given economic uncertainty and high interest rates, the credit formula is just one factor in the larger housing puzzle. And this is very, very true. We'll stop there. But the affordability issue is still very much there. But then when you add into that a lower credit score because someone hasn't had enough time to build their credit up, maybe they're making good enough income, but they don't have the credit score to be able to buy because they've always had to rent because of the affordability. You know, once they do get enough money to be able to buy, now they're delayed in buying because they don't have the credit score to be able to qualify. So this would help address that. For those that are stuck in the rental position, this gives them the opportunity to be able to build credit in that scenario. So I could absolutely see how this could radically change the way credit score is done and give a more broader picture. You know, and I'm sure there's issues there, and there's going to be a lot of hurdles to try to get through this. I mean, I don't know what all those are. This is just an article that just kind of popped up. I didn't know anything about this until this morning. So there you go. It is what it is. I think it's great. I think we're heading in another direction. They're addressing these issues. I think it's good. We need to be doing that. All right, guys, we're going to be wrapping up now on the last article. I'm going to make it through all 4 of them today. I don't usually do that. We're going to be just going through this real quick and just talking about this. This is an article by Inman. This is by Jimmy Burgess. He does a lot of agent training and things like that happening inside of the industry, and it's just sometimes good advice. So I thought I'd bring this one up to end this show today, just to kind of give you guys, agents out there, some thought. And even some of this is even consumer focused. So those that are not an agent can benefit from this. But this article is going to be talking about the kind of like this, the whole idea about the myths that are holding the market back, kind of like what the media is circulating out there that makes you kind of feel like this wait and see type market, and how it's really not the truth. That's not really what's happening here, and how that kind of verbiage is paralyzing a lot of both sellers and buyers. And it's going to cut through a lot of kind of the noise too about pending crashes and all that kind of stuff, right? So let's go ahead and jump into this. All right. It says, what won't happen? The 3 market myths holding your clients back. So these are 3 things that your client has in their mind that's keeping them probably from entering into the market because someone's told them that, the media's told them that, or what it might be. And I would just encourage you, these are 3 things that if I was an agent doing a lot of social media marketing, I would go out and start talking through your social media posts. It says, what matters most right now is providing information and clarity for clients. It says, in a market filled with uncertainty, hesitation becomes the default. Buyers pause, sellers second guess, and agents, if they're not careful, can fall into the same trap. Waiting for clarity instead of creating it by actively combating real estate market myths. All right, so we definitely need to be very in tune with what's going on in the market and not falling into the traps that we're hearing the consumer talk about. We got to be able to respond to what's going on in the market correctly. All right, but here's the reality. When there is clarity, there is confidence. And when there is confidence, contracts follow. Think about this. The media and the news and the headlines does not bring clarity. A lot of times they erode the confidence of the buyer, because if you're trying to build confidence, it doesn't sell as much. But the crazy, excitable type headlines sell ads. So we need clarity. So as agents, we need to read through that and articulate that with confidence, because we understand the market. And if we do that, it will lead to more contracts. Recently, I sat down with housing expert David Childers, president of Keeping Current Matters, to break down what's actually happening in today's market and, more importantly, how agents can communicate it in a way that moves clients forward. Because the agents who win right now aren't the ones with perfect predictions. They're the ones willing to provide informed perspectives. Informed perspectives. First, you got to be informed to be able to provide your perspective. As Childers put it, nobody has a crystal ball, but the professional who says, here's what I see in the market right now wins. And let me say this, guys. You can't say that, the professional who says, here's what I see in the market right now, unless you are informed. The only way you can make that statement is if you are actually reading and studying these things. And I do this every single day. Like every single day, I'm seeing what's going on in the market. That's the point of this entire show, is to help you guys stay on point about what's happening in the market. If you notice, we start off with talking about the interest rates. We began there because that's the most talked about in our industry, right? If someone asks how the market is, typically they're looking for the answers of what's the interest rate right now, right? And then you got to be able to articulate that to bring clarity to about what those interest rates mean and lead them with confidence into the market if it makes sense to do so, right? The foundation for clarity is not what is going to happen, but rather what is not going to happen. With that in mind, Childers shared the 3 things that will not happen. All right. Number one, he says, inventory is not about to flood the market. Okay. We're not going to have this major rush to the market with all these homes coming out because it's just, inflation's happening. I'm gonna make my money, all this kind of stuff. One of the most common fears buyers have right now is this: what if I buy and then inventory explodes and prices drop? Okay, so that's the fear. It sounds logical, but it's not supported by the data. Childers explained it clearly. We don't operate in a market where this flood of inventory is coming. Yes, inventory is rising slightly, but context matters. Even with recent increases, we're still below pre-pandemic levels in most markets. And there are 2 major reasons why. It says homeowners are locked into historical low mortgage rates. Equity levels are at record highs. The average homeowner has gained about $128,000 in equity over the last 6 years. That's not the profile of a market forced to sell. Now, I'm going to pause for just a second and talk about this. Inventory is not about to flood the market. And the most concern is like, what happens if I buy now and something else happens on the market? I'm going to go back years ago. There was an agent inside of my office. He was 82 years old when he passed away, and he was 82 and still working real estate. And he would come in every single day in the office, and we'd have a whole conversation, right? And one of the things he would always say is he would bring his clients into his office, sit them right down in front of him and have a buyer consultation with them, which I still encourage people to do, by the way, is have a conversation. And in that conversation, he would get them ready to go out and start looking at houses. And what he would always tell them is like, look, you're going to be seeing a lot of homes, okay? There's always going to be more homes coming on the market. There will never be anything perfect that fits everything that you're looking for. But here's what's going to happen as we look for homes. At some point, you're going to come across a house. And when you walk through that house, you're going to start being excited about that house. And you're going to start talking about that house and how you can see and start visualizing yourself living in that house. And he goes, and this is where I'm going to tell you that you stop. You cut out all the noise about looking at more homes, and we come back to our office and we talk through the scenarios of you living in that house. And we begin to negotiate on that home. Because chances are you need to stop. You found the house. Waiting and hopeful and that something else might happen, or if now's a good time or not a good time, you got to live in the now. If you need a home for your family and this home fits that criteria and it's what you're looking for, you cannot live in like worry and fear and thinking like, well, what happens if another house comes on the market? Well, what happens if the prices drop? Whatever. You are buying a home for your family. You are buying a place to raise your kids and build a family. Like, if you find what you're looking for, stop and buy it. You could overanalyze things to death and miss out on great opportunities in life. And that's just a life lesson in general. Like, stop and buy the house. Don't worry about all the fear about what's going to happen. Yeah, we got to use wisdom. And I'm not saying don't do that. But at the same time, like, don't gamble with your life. Like, this is your life. If you find a home, you found a good place. Stop. The locked-in effect is kind of changing. I'm not big on that one right now. That's going away as we go forward. What this means for agents, this is where your role becomes critical. Consumers are thinking in extremes, either boom or crash. But most markets don't behave that way. They normalize. Your job is to explain that clearly, consistently, and confidently. These are a few slides Childress provided with visual data on what is truly happening. It says, despite the progress, inventory remains below typical 2017 and 2019 levels. Year over year is only at 4% growth. Pre-pandemic is less than 12.5. So again, remember, we're not in huge inventory range here at all. This would have to flip. This chart shows that we have been moving back toward inventory levels seen pre-pandemic over the past few years. But we are still below levels in 2017, 18, and 19. Inventory growth continues to slow nationally. Okay? All right. Nothing drastic. Number two, mortgage rates aren't going back to 3%. They're not. We're never going to see that in our lifetime. I could be completely wrong. I just highly doubt it, guys. Highly doubt it. The second major hesitation, I'll wait until rates drop. But here's the problem. Waiting is often based on a number that's not coming back, right? You're thinking of, even if it's 4 or 5%, you're thinking of a number that could be years away and years away of building equity, right? A gamble. Childress addressed this directly. I don't see a scenario where we go back into the 3s or 4s. Mortgage rates are at the lowest they have been in the last 3 years going into the spring and summer market. This is the conversation agents need to be having. This chart shows where mortgage rates have been since January 4th, 2024. Okay? So we go back to 2024, look where we're at. Okay? Look where we are. Now we're 6.4, but still, look where we are. This is perspective. This is crucial. Hey, thank you for subscribing. Appreciate that very much. Thank you so much. I didn't see who the name was that came through there. Who was that? Sorry, I was trying to catch you. Thank you so much for subscribing. Appreciate that on Twitch. Thank you guys so much. All right, forecasts consistently point to a range in the low 6s. That's where a stability is forming. And when you break down the numbers, the difference isn't as dramatic as many consumers believe. This chart shows the projections for rates over the next year from Fannie Mae, MBA, and Wells Fargo. There's your rate projections. What this means for agents, instead of debating whether rates will drop, shift the conversation to the following. Cost of waiting. Like, what is it? If inflation is happening month over month, then what is the cost? Every single month that goes by, the homes go up a little bit in value. So what cost are they losing just in waiting for the interest rate? What about the opportunity? What if there's a home on the market right now that looks exactly what they're looking for and they can afford that house? What should they do? They should buy the house, right? What about the long-term equity? What about the long-term play? 5, 10 years from now, right? What does that look like? Like, how much are they losing there? Number 3, home prices are not crashing. Home prices are not crashing. This is the third and most emotionally charged concern. Prices went up, so they have to come down. Okay, that's the logic. But again, that assumption ignores the full picture. Childress pointed to the long-term projections showing continued moderate appreciation, not decline. Even in markets where prices have dipped slightly, context matters. He showed this example. The number one market for price declines right now is down about 5%, but it has gone up roughly 75% over the previous 5 years. So the amount of equity that everybody is sitting on right now, that 5% is irrelevant. It's irrelevant. It's a market adjustment. Market adjustment, that's all it is. There's still a lot of equity there. And we don't see anything drastic happening here. Matter of fact, look at this. That's not a crash. That's normalization. This chart shows the percentage change in home prices quarter over quarter for the fourth quarter of 2025 according to FHFA. Now I'm going to turn on my shared screen on TikTok. There you guys go. I'm going to zoom in. Let you guys see this a little closer. Oops. Where'd it go? There we go. All right. Look at this. There's only a few little markets that are down, and they're marginally down, right? Texas is down 0.07. But you look at Kansas, 1.27 up. 1 point in Pennsylvania, almost a point in New York. California's up 0.19. So we're still appreciating, right? So do you guys see a crash? Is there a crash happening here? Matter of fact, like the job market, the job market is actually catching up. The income is actually, I say catching up marginally, but it is increasing versus above the appreciation level, right? For the first time in years. Okay? So these are all still factors, guys. Oops, zoom out, not in. Here's the next one. Home prices expected to keep rising. Estimated home price performance, December to December, as forecasted in Q1 of 2026. So here is the projection. Let me show this one. Sorry. Here's the projection of year over year. This year in 2026, we're looking at an appreciation of 1.83. 2027, 2.4. 2028, 2.93. So you think about percentages of increase month over month, and look what you're looking at, right? So think about the cost of waiting. Think about what the cost of waiting is. If you're watching this and you're thinking about buying, look at the percentage of waiting, what you're losing and what you're leaving on the table, okay? This is very important. The media does not like to talk about these things just because it's not sensational. It's not sensationalized. The real differentiator, your ability to communicate. Your ability to communicate. Here's where most agents get stuck. They have the information, but they hesitate to share it. Why? Because they don't want to be wrong. Childers offer a powerful analogy. A doctor doesn't give perfect recommendations. They gather the best information they can and make a recommendation based on that best available information. Then they come back and gather additional information in the future. They adjust their recommendation at that time based on the new database and any changes that may have happened, which is why they call it practicing medicine. We're practicing real estate. No one's sitting here saying that this is definitive, right? I'm not sitting here saying that nothing is going to change. This graph that you guys just saw is guaranteed to happen. Nobody's saying that. But when you look at the data, you see trends, you understand the information, you connect all the dots, you can then begin to articulate your opinion in regards to what that data tells you and guide clients correctly, right? We do this in every single industry. Nobody's saying it's a guarantee though, but this is how we make decisions. This is how we use wisdom, reason, logic, discernment. This is how we know. We research information, we gather the data. As agents, we should be telling this information. Our ability to communicate it makes all the difference. That's exactly what clients need from you. Not certainty, guidance. That is based on the best information available. Prince Shepherd, thank you for the follow. Appreciate that greatly, my friend. Thank you for being here and following me. Thank you so much. But this is the whole thing is like, guys, if we're not guiding, somebody else is. So one of two scenarios are happening. If you're not the ones out there speaking this truth back into the market and you're not telling the consumer, then the media is doing it. Okay? And then if the media is not doing it, your competing agent that is informed, that is not hesitant to share this information is doing it. And that means you're losing a competitive advantage. Our job as professionals is to understand this information, to be able to articulate it well, and to guide the consumer, our clients, correctly, guiding them, right? Not with certainty, but with the knowledge that we have. The question that changes every conversation, one of the most valuable takeaways from our conversation was simple but powerful. When a client asks, and this is so crucial, guys, this is what we're asked all the time. How's the market? Okay, when we were asked, how's the market? Instead of jumping into your answer, ask this. Tell me what you've heard. That's good, right? Tell me what you've heard. Then listen. Then listen. Stop. Don't try to talk over. Even if they're wrong, just listen. The one question does two things. One, it reveals their assumptions. So it's going to expose if they're assuming something about the market, not based on any information or any factual data. And two, it gives you the opportunity to correct them with clarity. Okay? You get the chance now to whatever's in their mind or whatever they're assuming. If you have the information and you understand, you can articulate it well and guide them well, it gives you the opportunity to correct them with clarity. From there, the transition becomes natural. It goes like this. Would you mind if I shared what I'm seeing in the market right now? That's how you lead. The agents who win this market, this isn't a market where waiting wins. It's a market where leadership wins. It's a market where information matters, perspective matters, communication matters most. Because in a world full of noise, the agent who provides clarity becomes the trusted advisor, and the trusted advisor gets the call. This is by Jimmy Burgess, is the Chief Coaching Officer for Home Services of America and President of Berkshire Hathaway Home Services. He wrote this article. Give him all full credit, guys. Inman News. But here's the thing. Waiting, back during the COVID era and pandemic and all this kind of stuff, waiting is all we did. We just listed a property, we waited for the buyers. When the sellers wanted to sell, they just call us and we went out and list. That's not how you win in this market, guys. And I say this all the time, and this is not meant to be anything against agents that are working, but when I say it's time to actually work, I'm not meaning you're not working. Everybody's been putting major hours in. The work, though, that you're now going to have to do is you're going to be diligent in understanding this intricate detail and this information to bring clarity to a market that is confused by all this noise. Okay, that's the work. The job is to position yourself as the ultimate authority of the information of the truth is what's going on so you can better guide your clients. And you want them to be coming to you. And so when I'm talking about social media and marketing and all that kind of stuff, guys, that is the best stuff that you could be posting right now. I understand TikTok and all that kind of stuff. It's all fun to laugh with the music and all that kind of stuff. That's great. It's all fun. But when it's very difficult for the buyer and seller to understand the market we're in, none of that adds any value back to the client and ultimately doesn't really guide them very well. And it doesn't bring clarity to their situation. I'm not saying don't do those things. Don't get me wrong. I think they're fun. I think they're a blast. I like watching them. I think agents are some of the most creative people. I love it. I'm just saying don't just do that. Very good. Guys, that is, I got through all 4 articles, man. Shocker. Let me know what you thought. I appreciate all the follows and likes and comments and hearts and everything, guys. I greatly appreciate that today. Thank you, guys. I appreciate it because I don't want to waste your all's time. I just don't. This is a show that I've just kind of said, look, I'm going to do this. I'm going to invite you into my process. That's what I'm doing. And if it's providing something helpful back to you guys to help you guys build your careers and your businesses and do well to serve your clients and just build the real estate industry as a whole, then I feel like I'm doing what I'm supposed to be doing here. And for that, I'm grateful. Again, all the likes, follows, and all that kind of stuff is just telling me that I'm hopeful that I'm doing that. That's my goal. I do thank you guys. Just so you guys know, I'm doing this week, Monday through Thursday, 8:30 a.m. Eastern time, where you're watching me now. All the recordings, all these live streams that I do is hosted on the YouTube channel, The Real Estate Advantage. You can go check that out. Look for my face when you search for the channel. Consider subscribing, liking, all that kind of stuff. Do greatly appreciate that. But there's a lot of good live streams up there that I've done talking about just many different things. Go back and check them out. If there are articles that you want me to check out that you would like my opinions on, not that I'm some kind of great orator, but if there is something that's you've heard in the market, if there is a consumer or client has asked you a question and you don't have an answer to that, I welcome the question. Ask me. I might not have the answer, but I'll research it and try to find the answer. And I'll go into the weeds for you on that. I'll come back with some kind of response. But I like that. I want that kind of communication. And here's one final note. This is the 49th episode of this live stream I've done. So tomorrow will be the 50th. I will have done 50 live streams for this in this format. So it's kind of wild. It's been a fun ride. It's been fast. Those 50 episodes have went really, really fast. So for those that have been here the whole time, thank you guys. Greatly appreciate it. All right, I went over. I hope you guys have an amazing day. Enjoy the rest of your week if you don't come back this week, but hopefully you do. But if not, have an amazing week. I hope you guys sell a lot of houses, represent people well, make a lot of money, serve people extremely well, and just keep representing the real estate industry like you guys always do. That is your real estate brief for today. If you found this helpful, please consider hitting the like button to tell YouTube you would like more of this type of content, and consider subscribing to join a community of real estate agents that are focused on building a business that is relationship focused first. There's always so much more that I could be talking about, and I've done a lot of talking today. I will see you tomorrow morning, 8:30 a.m. Eastern time, right here where you're watching me. Take care. Bobby, have a great day as well, my friend. Thank you, my friend. Have a good one. All right. See you guys.